I went completely bust after the '09 crash. I was down to a jar of coins and $35 in credit on a Discover card. I was expended. I had eviction notices on my place. Time is ticking. I just was focused on how do I come back? And that's a one foot in front of the other. When March 2020 came around, man, I'll tell you, it was the first time in my life I was somewhat ready for it. I went shopping at the peak of blood in the streets.
Welcome everybody to Investing in the Minefield, where we talk about everything from macro to crypto to gold miners and gold and precious metals themselves. Please remember everybody that everything that we talk about is purely for engagement and entertainment purposes only. None of this is investment advice. It's purely just our views. You've all got to do your own research and decide what your own risk limits are before you're investing. So here we are coming up to the end of the first quarter, the end of March. So I wanted to take stock with Eric about what we've heard and what we've seen over the last few months, but also to dive into the trials and tribulations of being an investor in this very, very volatile space, particularly the junior miners, which seems to be such a painfully difficult environment for such a long period of time with so many haters around it now. So I'm going to chat to Eric, not just about the experience of investing, but some of his longer term experiences, investing in general, investing in highly volatile stocks and assets, and how he's come through those experiences. And welcome back, Eric.
Hey, Roger, how are you today?
Very well. I think this week it's going to be a little bit more of a sort of how to pull together our learnings of the last quarter, because we've been on a bit of a journey. We've seen a lot of breakouts in prices. You've had your conversations with some of the legends in the space. And I'd like to kind of take what they've been saying, plus what you've been saying, plus some of your experiences, and pull it all together, because we're still in this world where, we've talked about how tribal it is, but actually how you've been talking about throughout this journey, the importance of being able to combine, as you call it, your defensive assets with your offensive assets, which we'll come to. But before we get into that, here we are. It's the end of the quarter, end of March, and it looks like we're going to get that fabled close above 2100, even, as we're talking here on Tuesday, the 26th.
I find it very encouraging for a number of different reasons, but I've been saying this, as you know, this is what I've been harping on all along in terms of, gold can really mess with investors' heads, but I look at the price action because the market, I believe, always will prevail. So whether it's delayed, it's not going to be denied if there's supposed to be some sort of a trend move. Now, when I was talking about 2100, it was a key level going back a decade, really going back forever, because gold had never been above that level or closed above that level on a monthly basis. We've had a big consolidation for years where we had a triple top that was going into the low 2000s to test that all-time high. Each time, rolled back. So a lot of people thought it's going now, it's going now, it's going now. I think based on the way things have played out with this extra sideways pattern, this extra flag on a long-term duration technical chart is actually even way more bullish and potentially sustainable. If gold was at 1500, I would not be this keen on investing in the mining sector, but it's not. It's actually breaking an all-time high on a quadruple top. And I look at it on the monthly closes to be official. We're going to at least 2,600 on the low end to 3,200 on the high end on the, let's call it the phase one explosion out of these new highs that has been building up energy for, let's just look at the last decade. It's ready for that. And it's not even, we know of gold as being this stable asset. We see gold close, say, above 2,200 at the end of this month. I don't know if it's going to happen in April or whatever it is. Doesn't matter. By the end of the year, I would call for, at an absolute minimum, 2,400 to 2,500 by the end of the year, and probably more likely 2,600 to 2,800 on gold. Now, that's a big move in gold, right? That's 30, 40%. 25% of moving gold in a 12-month duration. That's pretty substantial for an asset like gold that is so big and so mature. The question we can get into then is, at what point, what level does it need to finally breathe life into some of the smaller mining stocks? We haven't seen that yet.
And that brings us on to really what is, I guess, why there's always been the cynicism, or why we know there is the cynicism, particularly now, is that the gold mining sector in particular is an absolutely brutal sector to have to deal through the various cycles. I know you're looking more for the playing those cycles, but a lot of people have had their hands, their feet, their ears, everything burned. How do you come back from that? I mean, how do you actually kind of go, Christ, I'm on the brink, and I don't mind, I'm going to go back and do it all again? Is it you've got to make sure that you take those risks when you're young enough to be able to bounce back? So therefore, people my age, with my life, kind of not life expectancy, my life goals, I should probably have a sensible allocation rather than an all-in allocation. How do you deal with the adversity of when things have gone not just slightly wrong, but seriously wrong? Because we're in that space where for some people that's going to happen.
I went completely bust after the '09 crash. I was down to a jar of coins and $35 in credit on a Discover card, and I had to last a week to eat before my check came in from my firm, which, by the way, I was working on 95% of what we were doing was deal flow in the private markets and in venture. And as you know, that all dried up. Nobody was doing shit for a while. And so, I had some money put away, but then I had to liquidate to pay the bills along the way at very low prices as well, which drove me insane when I knew that these were buys. And I tell a story about how I did bounce back from 2010, where I'm facing eviction on a studio apartment, by the way. I was in my almost mid-30s. I'm a grown man. This is the second time identifiably. The first one in my mid-20s, which I give myself a little leeway on because it was the first time I made a bunch of money ever, and then I lost it all back. But it was like I didn't have the experience dealing with cycles. I didn't know better. I needed to learn. But then when it came to the financial crisis, it was bad. And you're also dealing with things like your ego. You're dealing with things like humility. You're dealing with things like self-confidence. Can I come back? Whatever. There is a benefit to, and I do encourage people that are younger to take on, more risk, because you have the opportunity to protect yourself, or that's why I like Bitcoin, or taking high risk in tech or other, sort of high risk reward type of investments the earlier on that you can, so that you can actually get ahead with your money of this pace that is happening. Otherwise, at least get it into gold, where your storing power of purchasing is going to be there. But I talked about how my best friend from college was having his third child, and I was in Chicago, and I actually did have an office. I was running behind on the payment, but I did pay it. But I had this studio. I was in the Gold Coast of Chicago, so a nice place. I don't think I was living in the gutter, although I had been when I started my career as a broker and dropped out of college at 20. I became homeless for a few weeks. I had a change bucket. I had ramen noodles in the cupboard, so I could at least eat a meal or two a day. But I was expended. I had eviction notices on my place. Time is ticking. Everybody in the world was hurting and scared at that time. So it wasn't like you just go to a buddy or whatever and they have a family and they're happy to borrow you, even if it was a small amount of money at the time. Here's a few $5,000 to get caught up so you don't get evicted. It was actually very interesting with that whole thing. But I go to the hospital to go say congratulations to my best friend and his wife and meet his new son. And I'm walking into the hospital and I'm like, I can't go up there empty-handed. What am I going to do? So I walk over to the gift shop and I buy something like it was like not a toy for the child, but it was like a flower, a fake sort of flower, a real flower. And I ended up remembering they ran the Discover and it was $28. So I had $7 in my credit. I don't know how much was in the change bar or can, but it wasn't a lot of money, man. This was change. Maybe if I went to the bank like this, I would have got, 20 to 40 bucks. I had to last a week to live. And one of the things I mentioned in that newsletter where I told this story, I'm like, I said I was broke, but it didn't mean I had no class. I went ahead and I did that, and I had to have faith and belief that things were going to end up working out and changing. Anyway, long story short with that is that's how bad it got at that time. But I was, if we're going into, that must have been in 09 or 10. And it was very close to when my entire life changed, that I left the brokerage industry with 6 licenses. It was all I ever knew for 16 years, since I was 20 years old. And I became an entrepreneur, and I wanted to become an internet marketer, but I had to learn it all. I went in the data business selling, family office lists and RIA contact lists to pay the bills. And then I went into, internet marketing and starting the Gold Investment Letter in like 2011. And that wasn't a fast success rate. That was a plodding along to do it right. But there was hustling going on in between there where I'm learning all these new different things. So the point is with that how do you come back? Well, the investments were all gone. I didn't even have anything to work with. So what do you got to do? You got to make some money. And so I started to chip away at that and then build up more of what I could invest in. And it was something I took from a patient, longer term perspective, because I'm like, if I try to do something again, which is what got me into trouble in 2000, 2001, and what got me into trouble going into 08, 09 was too much risk, too big of position sizes, that when I got turned upside down, I was forced, and especially without predictable income. You're not making money for a few months or 6 months or whatever, can't pay your bills, that's draining out. You're forced to liquidate investments that you actually still really love long term, but can't hold them. Terrible position to be in, and I've been there. And probably been there to a degree, not where I was like flat broke more than twice. But this is as a 25-year-old man and a 35-year-old man. I mean, I was a grown-up, all right? So it's not easy, and I realize I hate being completely broke more than anything in the world. So I just was focused on how do I come back? And that's a one foot in front of the other. I'm 49 years old. Since I was 20 and left undergrad to become a stockbroker, I have drawn a salary from a corporation exactly 7 months during that time. The rest of it, commission or production or starve. That's it. I'm used to it. But I had to do that coming from a weak position. It started to slowly work out, but I did a lot of work on feeding my mind, like I couldn't stay in a dark place of doubt and lack and these things. I mean, this may be a little hokey for people, but hey, there are some listeners out here who are in a rough spot. You can get out of it, but quit freaking focusing on all the mistakes you made and regret. Get into today. It's a new day, and look at what you want to do and start moving in that direction one step at a time. And sometime in like the mid-teens, Roger, I bring this up because I started to get some traction, not just with the Gold Investment Letter. That was a very slow burn where I could actually make money from it. But it was one that I treated, like a sanctuary, where I said, I'm not going to cut corners. I'm not going to like take lists that I have of investors and upload them as opt-in and, try to cut corners. I did it all organically. I did it all right. I did it slow. And I tried to do my best with it. And then I got a big boost by picking a 25X winner in Canada between August of 2012 and 2013. I took a $25,000 loan out because I had no extra capital, but I'm like, I've got to participate in this with my clients because this thing's going a lot higher. I was so convicted. And I got that loan. And then that turned into, 100, and I paid them back, and I had a little capital, and, one step at a time. But somewhere in the mid-teens, I forgot exactly what it was, but it was probably 14, 15, wherever we had like a big downdraft, particularly where a lot of my money was in the minors. And I got into that position again, where it was like I was in a position of weakness in a market where I knew that there was free money laying on the floor. The value that I saw was incredible. It wasn't a March 2020 crash or an '09 or something like that dramatically. But it was me again in this position to maybe a lesser degree. But that's where everything changed for me too, because I adopted a couple of principles that were like personal to me and just, evaluating my beliefs and everything. But it happened again. And I said to myself at that time, like 15, 16, this is never going to happen to me ever again, where when a market goes and we have a black swan or whatever it is, and I see things that I'm very familiar with that are trading for 70% off, I am not going to be the guy that has to get squeezed out of those to pay my rent. I am going to be in a position where I can buy some for once at that time. So I reformulated my whole life, and I did it slowly, which is just like auto deduct cash to a Capital One account that I don't even know the password to anymore, because I really gotta have some grit and some instinct and go want to get that money to put it back to work. I put it over here. I took some cash, I put it at my mom's house under her bed, little pieces at a time. But then when March 2020 came around, man, I'll tell you, it was the first time in my life I was somewhat ready for it. And I went shopping at the peak of blood in the streets. And for me, as a stone cold, emotionless investor and maybe person with relationships, I try to not be emotional to make decisions in investing. And when I started to feel it, and coupled with the charts, how extreme they were oversold, and coupled with the feedback from my investment letter people, the fear that I saw, the angst, everything, all that I literally rang a bell. I wrote up an email, but first what I did is I went in with cash that I had and I loaded up on SLV silver long duration calls. And I said, I think the bottom's in. And most people, mind you, they're so scared shitless. Not only are they not going to take any action from me, but they think I'm out of my mind. Some people did, a very small percentage, that think the way that I think, where it's like, can you have the self-awareness that you're feeling a certain way and it's a litmus test for where you are in your market and your experiences in the market, and yet take contrary action in the face of that? That's not easy for a lot of people to do. But I was able to do it that day. And those SLV call options, but by August, were up between 10 and 15x. It was a great point of like, I got my head on straight before everything was perfect. You know what I mean? Like I was still dealing with trying to get ahead, but I started to do things a little bit differently, and that's what got me ahead. So
having had tits up at 25, tits up again at 35, do you think the balance that you now have in your portfolio, so although it's still high octane, as we said from day one last year, do you think your style of investing now and the balance in your portfolio with gold, but also your high octane stuff, do you think that you will not have that scenario again? Even if we have a correlation event, do you think that there is sufficient preserved wealth in your, for instance, pure gold scenario that you shouldn't actually experience that 25-year-old, 35-year-old experience again?
Well, listen, I mean, anything can happen to any of us. This world's a crazy place. But that said, it already did happen to me. Like if you look at end of 22, early 23, with most of my capital having been in crypto and miners, you hit a bottom in the crypto. So I had an all-time low again versus the high in my crypto assets. I had almost a low in my gold and the miners assets. And guess what? Because I did make some changes on the way up, and I secured my future. I bought condos and I bought a church. I bought all kinds of stuff in cash. I bought gold that I did not sell to go buy back crypto. I have, I put investments in things that are just not correlated. I also wanted to do it with things that I couldn't touch. And I don't ever have to work ever again because I took huge fucking risks, okay? Crypto, the miners staked me. I thank that area forever because those big winners I had there gave me enough experience, confidence, and capital to stake doing things the right way in crypto, which changed my financial profile forever. It's not like I didn't take massive hits, not to mention the ones that I held on to in crypto that had been up 200-fold that are then back down 90%. But I had a realization. I'm like, okay, the risk I took the reward has been realized to a very large degree. I need to get this out of this sector and put it in something that I can't touch, that is safe, because I have now real wealth and I can't treat it like I'm a 25-year-old guy trying to claw my way back so that I can go out every weekend and pay for the bar.
I mean, I'm very, very glad you diversified there, because when you're saying, oh, it happened to me again, I just thought, God, you're not selling me this strategy here. But the key point is you have diversified.
So I feel like I have learned from those painful mistakes. But that's part of the challenge. Can we actually learn and then literally implement some changes in how we go about things? And I've been able to do that. I think hopefully it's just getting better and wiser, not relapsing into some of those bad things.
It's like the trials and tribulations of a crypto and mining investor. But from that, I'd just like to take a change of direction and think about, you had these experiences, but putting the practical experiences now to work and maybe hearing a few of your ideas on how you run your portfolios and how you look at these risks. It feels like, and I know we're looking for that cyclical move, but it feels like investors who are going to play this not just cyclically, but maybe for a bit of a longer term, you have to be, now I was saying, not really balls of steel, but balls of gold, not like David Beckham, but, you've got to be able to stand some extremely stressful, difficult environments in which, we heard Rick Rule in the mining space. He kind of nearly went bankrupt, and Rob McEwen fought unions, got through that, got a good business, then spent the last 10 years dealing with mines blowing up and flooding. It's a hard business, and it's not particularly easy being an investor. I know investors who are waiting and still waiting for these bloody miners to get kick-started. I mean,
You're absolutely right. I always say that the two shittiest businesses on planet Earth, the hardest, are the mining business and, to me, the movie business. I've lost so much money, most in both, but mostly in the miners, because it's a very tough business, especially when you look at speculating, and a lot of us finance junior exploration companies. So there's no money coming back into the coffer. They're far from revenue producing. It's all outflows with the hope that you're going to find a new ore body or expand an ore body that you could do enough work on that actually shows that it's got economic potential to build a mine. And there are so many stages to that. It takes so much time, or that you can sell it, to a major for a big profit. So it's not, in general, a business I would recommend. When you have headwinds in a space like this, like we've had, it can be very painful. So then you have to make a decision. What I care about is going forward. But I also know, like, if you talk about Rick's story, you talk about Rob McEwen's story, these are the guys that I look up to if I'm going to ever go to the next level, and they've done it, and they're still in the game because they love it. What were the themes there with the operational challenges Rob had, like not even that long ago, with McEwen Mining after he was already very wealthy, to going back to the Red Lake thing with, death threats and all this stuff? None of that was clear, and he was in the trenches building a company and taking huge risks along the way, and a lot of pressure, to the point where you're getting threatened. Then you have Rick, who at one point was very close to bankruptcy, decided to negotiate with his lenders. Those times are not easy. Those are hard. Those are fights. Those are battles, They earned their wealth because they went through that fire. But we have to earn this, Patience is also still a key, and that's where a lot of people get tripped up. I see this, and I've seen plenty of evidence already in the mining space where people that have been in it for such a long time, they're like, screw this. I'm out, I'm done, whatever. But yeah, if you're mostly pregnant in that space for the last 3.5 years, it's very taxing, and you have to have resolve to get through it. And you also have to have solvency enough to pay your bills and get through it and not get squeezed out at the bottom, right? It's a tough battle.
Well, you said resolve there. I mean, it seems that people in this space are dedicated, but they seem to like an exquisite form of pain and almost masochism, because it feels like this is a sector where people are deeply passionate. They're in it for the long term, and they're in it through the highs and lows, which means that, as you outlined yourself, maybe some of these were pre-mining and more in the venture space, but deep lows where you've been on the brink. You have, Rob has, Rick has. And it seems that it's almost an irrational form of investing where you almost feel that to earn your spurs, you need to be on the brink and then have that incredible rally back up. I mean, does it take a special type and maybe a slightly unhinged type of investor to be playing this sector, these junior miners, not just in gold, but silver, vanadium, whatever, on a long-term basis if you're only going to be kind of in that one space, because the highs and the lows are very, very high, but very, very low?
I don't recommend just being in that space. Like, I literally have some of my members that when I get on a call with them or something, not as their financial advisor, it's not financial advice. And I have some very wealthy people, and they're telling me that 90% of their portfolio is in mining stocks. And I'm like, dude, are you out of your mind? Like, I'm not even out of my mind that much. Like, you got to have some things that are uncorrelated and everything. So the three biggest qualities for me personally to determine what's what, where's where, keep going, keep pushing, or get out, or what do you do? First of all, it's, self-awareness is a big thing in terms of, who am I? Do I have a tendency to, am I a gambling tendency where I have something inside of me that wants to lose and loves the pain? Do I want to continue to be this way? Or is it something where, the second thing, listening to your instincts and your gut? I have a gut. I have an instinct for certain things. And then the third piece is education. If you know about how markets work, you're not going to avoid volatility or cycles that sometimes can go against you, and they can be very difficult. But such is the nature of areas in the market where if you're seeking alpha and you want to beat the markets, the sun comes out another day, unless here's what I would say at the end of the day. These things go through boom bust type cycles to a degree, cyclical and secular bear and bull markets. And we just endured a very brutal one. One of the worst I've ever seen has still going on, especially on that low end of the market. Junior miners got my attention because I've seen bull markets in mining stocks, and they can get nutty, man. They can get nutty. They're the only area that I believe will end up competing with altcoins returns and crypto in general once they kick into a real bull cycle, and they're coming from such a low base. Nobody wants to play it right now. Everybody hates it. And that makes me all the more interested that, we're just closer to whenever that is going to turn around. And it's probably, for a lot of companies, when things really see capital flows, it's going to be a violent change, which I'm all for.
There's two sort of points I'd like to pick up on there. The first one is actually just a summary, and then the second one will sort of move us into kind of that risk management, because the first one, and it's the first point I think you made of the three, which is being self-aware, which for me is always a case of know your risk limits, know your objectives and your goals, know how nervous and twitchy arse you'll become if your portfolio is volatile and could lose or could have a massive drawdown. And then the second point I think, which really comes on from that, is something you've talked about at length, and I guess really brings us away from the idea of concentrated exposure as you might be if you're a mine operator, if you're all into the junior miners, but really thinking about risk managing these positions. And we said at the very, very beginning today, and you said it all along, which is the importance of having offense and defense. Basically, when you're thinking about your self-awareness and thinking about how you can manage a portfolio, you want those things in there, your gold, which will be a safety net, and those things which will blast to the stratosphere if things go well. But one of the things which, again, I'd love you to highlight, which is these are not static allocations. These are ones where you're dynamically looking at Bitcoin off to the moon, take some off, put it into the dull, maybe miners or the underperforming miners. Because I think that's the essential part here. We talked about it. There's the tribes, but you're saying don't be tribal, be opportunistic. There's lots of hubris out there. Take some profits when everyone thinks it's hell on earth, go into it. Could you just go into that? Because I think that is actually at the core of why you see this as all these are complementary when a lot of people out there are knives out for one or the other.
The toughest part of this business is when and how to sell. So you have to deal with the exit and when do you start to take some of that off and reallocate. I want to be clear too, when I redeployed emergency cash, including physical gold that I had bought towards the tops in 2021 because I had too much crypto, was getting too nuts. I mean, you take a lot of risk, and then if the reward is actually realized and over-realized, and it becomes a certain percentage of your overall portfolio that becomes a little uncomfortable, it just doesn't seem wise. I started to peel that off and then move that into lower risk assets like real estate, cash, gold. And then, come into November of 2022, S&P still down 50% or whatever, Bitcoin 65, 70%. Everything's been crushed, QQQ, all that stuff. And I looked at my physical gold and dollar prices and it was down 1%. So I took the gold, I think it was all of the gold that I had bought with the crypto because I have a core gold, physical gold position anyway. It was most of it. So I ended up starting to liquidate that and put that back into crypto during that scenario, but I used that as the rainy day cash fund. The point being, it's the sitting, it's the waiting that has always made, like Jesse Livermore said, the big money. But I'm in it for 10, minimum 10 to 30 to 50 to 100x. So how do you get there? You got to give it some time, right?
I'd love to just dig into that because when we talk about that waiting game, waiting is resilience, but that resilience can become stubbornness and eventually it can become idiocy. Now, when we look at these things with hindsight and they've gone up, we go, oh, they went up. But some people will be sitting there, you could be down for 3-4 years. But is the key point here is that you're not concentrated in one stock or one sector. The point is that you've got your defense. So if you're being patient, yes, it might seem to somebody who's only long that one stock or sector, which has gone from resilience to stubbornness to stupidity maybe and idiocy, but you can run those because you still got a significant portion at this point effectively defensively deployed or decorrelated deployment in other assets.
Well, as you know, that's not what my portfolio looks like. I'm
talking about normal people now because you're normal investors, not the ones
normal people that want to go to the next level in their financial profile. I've been able to do that through my investing, taking a lot of risk and also making a tremendous amount of mistakes along the way. But what I'm talking about is one simple thing. So you're right. That can turn into a curse if you're stubborn, where you're up and you go through this bull market and you're up on paper a lot, and then because you missed the top, you hold it. Oh, when it goes back, I'll sell it. All the usual gambling psychological talk that by the time it goes down after 3 years, 80-90%, you are calling yourself an idiot and you're like, woulda, coulda, shoulda. I'm talking about giving something time. If you've endured that part already, a bull market, when it switches, doesn't last a month. Give it time to get, if you're in a bull cycle, you need to give these things time to reach their potential. So if you're talking about a cyclical bull market, okay, or if you're talking about a secular trend, hopefully it's a secular trend and within that is a cyclical bull. I'm talking about giving it time when it's wise, not when it's stupid. If you've already went through the bull market and you're trading at these nosebleed levels, you don't want to be stubborn. You don't want to be a moron. You got to lock in some level of profits and then some, especially if you're up 5 to 500 times your money. It would be moronic not to take some off along that way so that you can say, look, worst case scenario, I sold, a third of my position at 5x. I've already doubled my money with my principal. So therefore, if I ride this all the way back down through the next cycle, because I'm very long-term bullish anyway, so be it. It's not going to hurt as much, right? But I'm talking about giving it time. You don't want to be the one when it's already up hundreds and hundreds of percent to finally get around to putting some money to work, because you're putting yourself in a tough position.
Absolutely key is that ability to take profits, to sell the winners. Because actually, when we talk about the people who have kind of faced the bankruptcy, nearly all of them did ride it up. They rode it up, did well, but then didn't sell and wrote it down, or they used too much leverage as they went up, so when it reversed with leverage and then killed them. And we can see that with even the meme stocks where everyone got in, what is it, in 2021, and have been arguing on Twitter ever since as those meme stocks have deflated because they never got out. Sounds like effectively what you're not saying here, and I know it's one of the loves of particularly the crypto spaces, hodling is not a good idea. What you should do is, when it's up, take some profits, go down, get back in, then you've got more in it when it goes back up again. It seems that it goes back to that important thing you said all along, which is it is so hard to bring yourself to sell a winner, but you need to have a strategy for taking profits on winners so you can fight another day, or you can double down when things roll over in a cyclical basis.
People have a binary thought basis. If I run into somebody that knows that I'm involved in Bitcoin, for example, and I was posting stuff on social media, and it's like a friend from LA I haven't seen, and then I see them. Should I buy Bitcoin or should I sell it? Should I buy it or should I sell it? It's an all or nothing decision. I do not operate that way. I take profits and I buy in positions in tranches. Psychologically, say for example, I'm going into a beaten up sector and I'm like, there's value here, but we're in a bear market. And like with the Pareto principle, where you can have 80% of the move in the last 20% of the time, it could get a lot worse. So what I do is I set a goal. Okay, I want this to be 10 or 15% allocation of my portfolio as my goal. Let's just call it 10%. I'll put 5% to work immediately in the stuff that I find attractive. If it goes down 20% from there, I'm actually pleased. I'm not upset. I will take another quarter. So now I'm 3/4 invested and buy it on the 20% dip. If it goes down another 20 to 30% from there, so I'm cutting half from my initial buys, I'm actually pleased because I'm going to own more of an asset that was already cheap that got cheaper. And now I'm going to have a full position if I'm ultimately right. So psychologically, these things play games on us, but always we tend to think of take profits or buy, and it's like the whole thing. I don't have that strategy. You know, people get caught up on this whole thing of like, okay, so you want me to buy Bitcoin? Is it gonna maybe go down a little bit first? It's like, shut the hell up. If you're gonna buy it, buy it. At least do it the way that I mentioned it. Buy half of what you want to get right now. Get some on the books. Your bigger risk is not owning any at all. That's what your bigger risk is. And now we have BlackRock and Fidelity and, Bitwise and all these different groups, Wisdom Tree, that are out there educating RIAs and institutional investors about the importance, or at least the benefit, of helping your alpha and by putting a small allocation into Bitcoin or crypto versus just being 60-40. Dude, 60-40, give me a break. But I'll tell you something. A lot of these people, the later it takes them with Bitcoin to have some allocation there for their clients, some of them are going to get into trouble because this is a fiduciary responsibility. And so we've got to be open. What I'm saying is we have to be open-minded to the fact that there are some elements to this game, just like markets change, where we should be flexible to do something.
A lot of people think about capital preservation, and they think of if I put my money in the S&P at 5,000 and it stays at 5,000, that's capital preservation. But obviously, what you're exactly saying here is that no, it's not, because of this currency debasement. Your 5,000 today on the S&P is not the same 5,000 in 5 years' time. It's deflated by the inflation of the money supply and the inflation that's been around. The only things that will beat that are things like your Bitcoins, your cryptos, etc. So if you want capital preservation, you actually have to take more risks in the sort of current environment we're in, albeit balanced risks where you put a sensible amount of your portfolio into something that has the potential to 10, 20, 30x. You have some of it in the section which is your defense, which is your true store of value gold, and then you might have something in the middle which you might want to play around with.
Absolutely.
So as we can see from Eric, he has experienced quite a lot. He's had the ups, he's had the downs, he's had the ups, the downs, and the ups and downs again. He's been through the ringer many, many times, but he's probably got a portfolio that now suits him. And he's someone who, by not shying away from risk, has certainly had those good times, but it's not been without pain. And obviously, that style is not for everyone. But the key element and the key message that he has really, and has remained throughout, is have balance in your portfolio. It might not seem that way in terms of Eric's love of volatility, but have some balance. And as we've always said, make sure that you understand your own risks. Make sure that you have what's right for you, because not everybody wants to go to hell and back to be an investor. In fact, most people would prefer to have much more safety and security. So always do your own research. Yes, the rewards can be very, very high if you take the risks, but taking those risks aren't for anyone unless you've kind of got balls of steel or you can deal with those ups and downs and have the personality for it. Certainly, Eric seems to have enjoyed his ride doing that and enjoys this space still even more.